Welcome back to Store University Lesson 5, How to Pick the Best Businesses Using the V-Formula Framework. I'm Chris Volk, CEO of Store Capital, and in the previous video I discussed how to use the V-Formula to evaluate the best business models. I concluded by sharing with you a V-Formula that presumes a company is fully funded by equity and is free of any contractual payment obligations that arise from the use of other people's money. Now you may be thinking, okay, how do you do this type of analysis with a public company? You probably have a retirement investment account. You may have opened an account with a discount broker to select some stock to invest in. Can the V-Formula help here? The answer is sure. Now, with public companies you're investing in, the investment amount is different from the actual dollars it took to create the company. After all, you're buying the stock at its current market value of the company. Your cost is just going to be different from the original cost to develop the business. So here's what you do. First, you do your level best to compute the actual cost to create the company. You start with a balance sheet, and then you start with the assets that have a cash cost, like cash and cash equivalents, accounts receivable, inventory, furniture, fixtures, equipment, real estate, which is basically assets before depreciation, and any assets held for sale, and intangibles like goodwill and trademarks that have been purchased. Now, while any entrepreneur worth their salt knows what their business costs to create, the accounting profession has lost sight of this important fact. Therefore, undepreciated fixed assets may actually not be stated at cost, nor might intangible assets. So we're doing the best we can in trying to compute a V-formula. When computing the investment required to create a company, you should exclude adding in any non-cash assets like straight-line rents, deferred assets, or conventions such as the right to use an asset. While the accounting profession can lose sight of the cost of cash outlays, the accounting profession tends to frequently book non-cash assets or assets that require no cash outlay at all, so you have to really beware. Against the cost of assets, subtract the non-interest-bearing working capital obligations, such as accounts payable, accrued liabilities. Ignore non-cash liabilities such as deferred income or deferred income taxes, and definitely ignore items in other comprehensive income such as the valuations of derivative instruments. I exclude tax items because I use the V-formula to compute pre-tax rates of investor return. Subtracting the interest-free obligations from the cash costing assets is going to get you the approximate investment it took to create the company. And there you have it, working to estimate the investment it took to create a public company. It's not as simple as computing the investment for a company you want to create. It requires almost a forensic approach to dig through the numbers, but it can greatly add to your understanding of a business and whether or not making an investment in that business is right for you. Next time we'll dive into the amount of the business funded with other people's money, or OPM, and then learn how to use the V-formula framework to evaluate public companies. Until then, I am Chris Volk. Thanks for joining me on this value creation journey.